Welcome to Flip the Cap, the industry's premier podcast that delivers insurance insights with a twist. I'm your host, Kathryn Smith, and I have the distinct pleasure of being joined by three guests for today's discussion. We are joined by two of Jencap's most seasoned and successful commercial lines brokers, Jim Andreoli and Tony O'Donnell. We're also thrilled to welcome Oliver Pidgeon to the podcast. Oliver is a managing director at Bowood, which is part of Howden Re, and brings over 25 years of experience placing delegated binding authority contracts in the London market on behalf of North American clients. Our discussion today will educate you on global current events impacting our domestic markets, emerging risks driving E&S innovation, the rise of the MGA, and much, much more. Whether you're looking for fresh takes, deeper insights, or a competitive edge, you're in the right place. So let's kick off the conversation today by pulling back the curtain on Lloyd's of London. Ollie, why don't you set the stage for us on the structure of Lloyd's of London, how it works with the various different syndicates, and the role that Lloyd's of London plays in the global insurance market today?
Really start with Lloyd's have been one of the longest standing insurance markets in the world. It's on a global basis. It's been the driving force behind some of the greatest achievements in humanity. In the 17th century, it was there and created really to build the shipping side of things. And really that's the basis of what Lloyd's is about. Back then it was a coffee shop, and there was a number of people that sat around that coffee shop, and there was somebody who was going to transfer their ship from point A to point B. And he didn't want to take all the exposure himself. So they all spoke to one another. They agreed with a price for that, and they syndicated that shipment. And they did that multiple times over. And as we fast forward into today's world, Lloyd's remains on that basis. It's a number of syndicates that make up the capacity that sits behind the risk. So when people see Lloyd's of London on their insurance policy, this isn't a one single insurance carrier. It's made up of multiple syndicates that will participate on that risk. And I think one of the things that Lloyd's really is recognised for is being a specialist on a global basis. So they'll write business around the world. They'll write multi-lines. Tony, as we were discussing earlier, they do bloodstock, they'll do property insurance. And when you look at their positioning in the US E&S market, they are the largest insurer on a collective basis, holding around 25 billion or about 16% market share on the E&S US market.
Now, Ollie, some people think that there are names that London and the syndicates are made up from just individual people, but is corporate money involved as well?
So there is some names which are individuals that do back the syndicates, but a lot of it is corporate capital that now sits behind those syndicates. And they'll range in stamp capacity, i.e. the amount of insurance that they will write as a syndicate. You take Beazley, which would be one of the largest in the market, that have a lot of corporate capital that sits behind it, and it will write tenfold of what one of the smaller syndicates does. But that's what makes our marketplace unique, is that we can source capacity from multiple syndicates that can form within their appetite a placement and capacity behind a risk. For example, on some of our Jencap placements that you guys are familiar with, we'll have 24 markets that will participate on any one property risk, which means the risk is always spread. It gives some robustness to your insurance placement insofar as if one of those markets decides that it's not in that class of business going forward, there's 23 others who will take up the slack for you. So it gives you a consistent capacity base.
And Ollie, just to kind of touch on the, how the terms are set. I mean, when you got so many people participating, trying to fill out 100% of a line slip or 100% of the limits, normally, and I think this is the case, that normally there's one or two that will set the terms, what they fear is a reasonable price for the exposure. And once that's set, you try to go around and get others to agree to those terms.
Absolutely, Jim. And there's sort of multiple ways that businesses place. So, we're talking today, we can talk about delegated binding authority, which Jencap hold on behalf of Lloyd's of London. they're contracts that are negotiated at their renewal date. You'll have a lead market that will set the term, and then we'll try and work with follow capacity to build out the aggregation and the premium income limits that's available to you guys to deploy. On a facultative placement, which you guys quite regularly send over to the London market, that'll be a case of finding a lead market that will set the terms, and then it's a case of walking it from box to box to box within the London market to try and encourage capacity to support those lead terms. There's instances where if the risks of a certain size, we might only take 10% lead market terms from the first syndicate that writes it, and they typically will be the largest lines. So there'll be instances where we'll have to put 10 or 15 markets on a placement in order that we can formulate the full amount of capacity that's required to secure the risk.
So Ollie, we're familiar with the North American market, but are there events that are going on around the world that may have an influence on the pricing in Lloyd's and the capacity available in Lloyd's on a global level?
Yeah, and I think you can look at the reinsurance market on a global level, inclusive of Lloyd's. I think in the last 5 years, so this last decade, we've had more catastrophe losses, or catastrophe losses that have exceeded $100 billion in the last 5 years. And historically, when I first started out in the insurance market, you really looked at natural catastrophe as being hurricane, windstorm, and earthquake. But you move forward into today's world, and actually a lot of those natural catastrophes are made up of flood, they're made up of tornadoes. It's a changing world from a climate perspective. I think this year we saw record size hail in Germany. And all of these things have an impact in terms of how insurance on a direct basis is priced, because ultimately they're backed by reinsurers. And I think that's been a big challenge that we've seen as a marketplace, particularly over the last 5-10 years, is trying to understand and address climate change. And I think that's brought some uncertainty to the pricing. But going forward for 2026, I think the outlook is fairly positive in the reinsurance sector. On the back of some decent underwriting profit years over the last couple of years, more capacity coming in the market. And I think that is being attracted by the fact that we're using analytical tools to look at risks better. There's risk modeling out there. We're trying to understand exposure better, and to bring a certain amount of certainty into what I would say has been a relatively uncertain climate environment that we've been in over the last 5 and 10 years.
Yeah, and I will say, Ollie, in the 37 years that I've been dealing with, London, both on a contract binding basis and also a open market placement, the market over there has really changed. I mean, when I first started, there were hundreds of syndicates. And that kind of went through a shrinking phase where syndicates, bailed out, and the number of syndicates, I think, went down to just over 200 maybe. But there was still the capacity, so people were putting up more lines. And then, I think as more capital started coming in the market, some more syndicates and some London companies, insurance companies, jumped on board. So now it's, really a robust market with really unlimited capacity if needed.
Yeah, and I think there's underwriting discipline in Lloyd's, and they have to respond to names. That's people's own capital that they put up to back these syndicates, and also obviously the corporate capital that sits behind them. But I think a lot of it is coming down to the fact that greater use of technology in our business. Jim, you'll remember when we first started out, or when I started out 25 years ago with you, I don't think we had risk level data that was reported across to London, and now that data is really the bedrock of every single negotiation that we have on behalf of Jencap in the market. And that data is then reported through to those reinsurers. So it's all the steps and changes that we've made over that 25 years to better understand risk, better understand exposure, and help better price risk so that they can be more certainty and more capital deployed in that environment.
Jim and Tony, when you're listening to some of the global trends that Ollie alluded to, what are some of the things that you're seeing as a trickle-down effect with your ability to transact business in the E&S market right now domestically?
I think Ollie kind of hit the nail on the head with their, risk level data and, their analytical underwriting. They strive for long-term, success. So, even over in the U.S., they may be experiencing negative results somewhere else in the world, but they're looking at it on a global basis. So in our little microcosm, we feel a risk is a risk and this is what it's worth. But in the larger scheme of things, when Lloyd's is involved, I think they try to maintain a lot of underwriting discipline. So you don't see them jumping in and out of markets, and you don't see them, you don't see the rates, them undercutting rates. It's more, they're more analytical and they're more long-term. And I think, over here, you kind of, Lloyd's likes to hold the line on a lot of things. Sometimes you think the pricing's out of whack, but they have the factual data to back it up and what a risk is worth. So I think, over here, we kind of get the trickle down, but we're appreciative because we realize the experience and the analytical tools that they have, that most of the time their pricing is what the price should be.
And I think, Jim, it's fair to say we probably saw this over the last 3 or 4 years, particularly in your territory. The market changed. The domestic market's appetite changed, again, driven by the reinsurance capacity that was available to them. There was a number of people that pulled out certain segments of the market, particularly on the coast. And you've watched Lloyd's stand up more capacity behind your facilities in order that you're able to write that coastal and step in when others aren't able to offer that product. And that has been through utilising all 24 of your syndicate relationships that you have built over the last 40 years of trading with London and the trust and faith that those syndicates have in you guys to deliver the right price, at the terms that are required at that point in the market cycle.
When we're having a conversation that is centered around Lloyd's of London and also the E&S market, reinsurance, as you've mentioned, is always connected to that conversation. So, and I open this to whoever wants to answer, or you guys can all, but how has the reinsurance landscape shifted in the last few months, and what impact has that had specifically on our domestic E&S markets?
Reinsurance is global, and most of the major reinsurers are on a global basis. So everybody in the United States is obviously familiar with a hurricane in Florida or a wildfire out in California or in Montana, but what they may not be aware of is there are events across the globe that are going to impact the reinsurance market. So as Ollie mentioned, you've got hailstorms in Germany or flooding in Tibet, or you could have windstorm in Europe. So a lot of those events don't necessarily get the press that they over in the United States. And I think Ollie used a phrase, back in the day that, reinsurance is the rising tide that floats everybody's ship. And as the reinsurance rates increase, then the rates globally will increase, and vice versa. As the reinsurance rates start to diminish, then you might see some capacity, freeing up, and, insurers in the United States have a little bit more less underwriting discipline. So on a global scale, the reinsurance market is going to dictate what the insurers do, and then the insurance, their appetite is going to affect what we see in the surplus lines market. So what we may not be aware of on the other side of the world is obviously having an impact with what we do in the United States. I don't know if you've got anything to add to that, Ollie.
No, I think that's exactly right. Tony, from a global perspective, as I mentioned earlier, these events are happening, and with greater frequency. And there's other, it's not just natural catastrophes that drive reinsurance pricing. We've got the war in Ukraine, the Middle East conflict that's out there. There's other things that will drive, the price of the reinsurance and what those risk takers have to bear. As I say, I do think 2026 has a relatively positive outlook. I think we at Howden Re would say it's a softening hard market, i.e. that the prices have been relatively high and retentions have been high within that marketplace. And we do expect that there'll be more capacity available from reinsurers, which will inevitably drive, some of the pricing down in certain areas. But I think we've gone through quite rapid inflation globally and in the US, and you guys and we've seen the insured values increase on properties. So again, even with more capacity that comes into the market, the expense of the risk has got higher as well through that inflation. So if there is going to be any pricing reduction or downward pressure on pricing or change in appetite, I think it will be relatively tapered, just on the basis that there is still, a significant amount of values that need insurance within the US. So it'll be an interesting year for 2026 to see how that develops.
I'm curious to hear from each of you, because you've been in the E&S market for so long, that tends to be a place for more emerging risks, things that other carriers aren't necessarily comfortable with from a risk perspective. But today, in today's insurance landscape, what are some of the emerging risks that are driving innovation in the E&S market that you haven't seen historically?
Well, I think, in New England and in our area, you're obviously seeing the tier one, or what most people call the coastal regions, where insurers are, the standard market insurers are less, or they're more reluctant to take on high capacity accounts because of the windstorm exposure or because of the flooding exposure. So that's really an emerging risk, in that we have to be able to then accommodate the vacuum that's left behind by the standard markets. And even though the standard markets' appetite is increasing, they're still staying away from the coast. So we try and take advantage of that by being nimble and being able to have the capacity and the aggregates through our Lloyd's brokers to be able to accommodate the gap that's being left by the standard market. There are obviously wildfires that are happening out on the West Coast that doesn't necessarily affect here on the in New England area, but the ability to fight the wildfires and to have forestry management is going to then have an effect on the insurance pricing, and whether or not a certain area has got forestry management in place or not, and will that impact the pricing on insurance in those areas. So there are various different areas. There are specific segments of the marketplace, such as active shooter coverage, which is an emerging market. There's cyber liability, but those are more not necessarily property related or Lloyd's related, but there are certain segments that are coming out. And then obviously there's the artificial intelligence that is coming out, which may have an impact on certain aspects as well. Another area that we see is the cannabis industry almost coming into liquor liability with the drinks that are infused with THC. And is liquor liability going to respond to an inebriated person drinking a THC drink or not? And those are some of the legal aspects that we have to address as well that are coming out in our area. So I'm not sure if that helps, but those are some of the things we see in our area.
Yeah, and Tony, I agree. And you touched on California. I think that's a huge challenge for the insurance market. To work out a solution as to find the insurance capacity down there. And I think it's not an emerging risk as such, but we need to find a solution. To be able to insure in California. The wildfire was an exceptional event and a tragic event as well. And, insurance is about a force for good and rebuilding people's properties in areas where they have losses. One of the things that I've been quite fortunate to see, I think, in my time is, again, how insurance can be a force for good. And there's something that we're proud of, I think, within Howden as a group. It's called Humanity Insured, and it's to provide parametric cover for farmers in Kenya. Who would never historically have had access to an insurance product. They have to invest in their crops, they buy their crops, but if they have a drought, they lose everything. Well, we're able to offer them a solution for the technology that's available out there through satellite imagery. If there's drought, they pay money, which means that they can reinvest the following year in their crops and keep their children in school. So, it's how we make insurance available to more people as well, because they might not necessarily emerge in risks, they're existing risks that we haven't found a solution for at this moment in time.
That's a great point.
Yeah, and the other thing I just I'd add, it's if you look at the U.S. property market, the E&S has always been, kind of the market that would take the stuff that nobody else wanted, or companies couldn't find a way to make money. So they would bail on classes or territories, and that opened up opportunities in the E&S side for us to try to find solutions. On the flip side of that, what happens is, especially in a territory like New England, there's a lot of companies that may bail on California business because they just can't find a way to make it work. So, they say, okay, well, where can we make this up? Well, let's go to the Northeast because we think it's vanilla. And they start writing classes of business that maybe they're not really experienced in, that really should be in the E&S side. So they'll take some of our, what we call vanilla business, but it should be E&S. So that kind of leaves us with kind of a pot of accounts and classes of business that are tough to place and that are, that have had losses that are not as desirable. And we see that back and forth, accounts going back to the standard market, then they get a taste of it and then they kick it back to the E&S market. So our market's always, fluctuating on what's traditional E&S business and what's standard market business. And I think these, catastrophes keep happening. Carriers keep jumping out of classes or territories. That opens the door for us. So, we're kind of sit and wait and see what they do, and just hope that they don't come back and try to take our vanilla E&S business. So it's ever changing.
Yeah, it's important to say we've been a cover holder for Lloyd's for the last 38 years, 40 years, and we've never not been able to write business on behalf of Lloyd's because we've maintained underwriting discipline and had the backing of Bowood or our London broker, and with that comes stability, and that's enabled us to be a force in the marketplace for the last 40 years. We've not gone in and we've not got out.
Nothing can outsell consistency.
Yeah.
And that's ultimately what you guys have built with your Lloyd's cover holder status and the capacity that you've acquired that sits behind you over the last 40 years. And whilst, new MGAs will come into the space, and that's prevalent at the moment, whether they last the test of time like we have, that's yet to be seen. We've done it for 40 years. We have, we were able to respond when the market changed and we needed more capacity out of London because of our relationships. Yes, there'll be new capacity coming out of other channels and new MGAs in the space, but let's not make judgment and see whether till they pass the test of time as we have.
So one of the benefits of having a 40-year relationship with Bowood and the London market is that we have generated a lot of trust and a lot of goodwill out of all the syndicates. And each year we've been able to add more to our capacity to become probably one of the largest single cover holders in the Northeast to generate funds into the London market. Now, with that enables us to go to the syndicates to ask them to be proactive and enable us to become leaders rather than followers in the New England area or the Northeast area, so that we can then utilize our capacity and our forms so that we can stay ahead of the curve rather than being reactionary. And that's one of the benefits of partnering with Bowood.
Let's pivot the conversation a little bit because there are a lot of new players in the market, particularly in the property market that you all deal with all day, every day. And that would be MGAs, the rise of the MGA. So talk about how that's changing the game a little bit and what impact it's having.
So yeah, it is a challenge. There have been an influx of MGAs with new capacity, new underwriting paper that seem to spring up all the time. The challenge that we have is the carriers that we have dealt with over the 37 years that I've been here, we try to maintain underwriting discipline. And I think when new carriers come in, these MGAs come in, there's a pressure for them to put premium on the books. And naturally, the best way to do that is to look at current pricing and go below it. So we're constantly struggling with, do we use MGAs? Sometimes we have to. Do we prefer to use them? Not when we can, because I think what Ollie had mentioned earlier is, we just don't know if they're going to stand the test of time. And ultimately, for the insured, that may not be a benefit. 1 year he may suffer or may benefit from a big rate reduction, but in 2 years, if that MGA's paper has dried up, they're back on the hot seat and they're going to take a big increase. So we try to look for stability rather than trying to chase the cheapest market on the street. But it is a difficult situation for us because we have to play in that space. And I think seeing the number that come in and the number that go out, I think it will continue for the next few years. More MGAs popping up, some going by the wayside, and so it's a constant struggle.
Just to sort of piggyback on what Jim is saying, I mean, the benefit of Jim and I being in the market for such a long time is that we've always seen the peaks and the troughs. And as the market softens and more MGA business comes into, we've not necessarily reacted and dropped our prices to sort of chase the market down. And in most cases, we've had to let accounts disappear just to maintain the discipline that Jim referred to. So with the benefit of the experience, we know that the market will always come back. We may hit a little blip for a couple of years, until those MGAs run out of capacity or their losses scare them off. But for the most time, the accounts will come back to us, or because our retail agents trust us to make sure that we're doing the best for them. And a lot of them will recognize that sometimes a newcomer isn't necessarily it may be gleaming and it may be shiny, but it's not necessarily diamonds. It could be cubic zirconia. So we just stay with the straight and narrow. Sometimes shiny isn't the best.
Yeah, and I think one of the things that we'll all agree on is that consistency is important. We are a market with an annual renewal date, whether it's the insurer's annual renewal on his insurance policy, whether it's your binding authority annual renewal date. What you don't want to do is 1 year have that capacity available to you, and then the following year that not be there. You guys over that 40-year period have stood up. You have a number of relationships in the London market, and I think as we went through a hardening cycle within the London market, you saw Lloyd's cut back the number of cover holder relationships that they had through that period of time, particularly from a property perspective. So, it is about who can stand the test of time. It is about providing consistency to your retailers and to the insured and to your carrier partners. And I think that's one thing that, working with you guys, I've certainly been privileged to witness is that consistent performance that you've provided for your carriers and the consistency of product that you've provided to your retailers over that time.
Before we go, I'd love to hear from each of you what your predictions are for 2026. We're sitting in the middle of Q4. All of our sites are already set on Q1 2026. What do you expect to see in the E&S market in 2026? Anything different than what we've seen this year?
I think it's going to be more of the same. We're getting indications from a lot of our domestic carriers that they're willing to, back 4 or 5 years ago, 3, 4, 5 years ago, you were looking at 10, 15, 20% increases. And now companies are, the premiums are to a point where they're agreeable to providing credits on renewals. It seems there's more fight for the same business. So carriers realize they have to loosen the reins a little bit. So I think it's going to be more of the same. One of the things Ollie touched on a little bit earlier was valuations. That's still going to be a very important factor in our property market. We've seen values, dramatically increase on everyday risks. I think that's going to have to continue. Insureds are going to have to insure to value. But with that, an added increase in value becomes an increase in premium. But I don't think you're going to see any dramatic changes. I just think it's going to be, kind of status quo, more of the same. A little bit of decreases. Again, if more MGAs pop into the market, that could dictate, a softer market. But I do think you're just going to see a little bit more of the same.
there are always going to be claims. There's always going to be fire claims, water damage claims, property claims, and the cost to adjust those claims and rebuild and get them back to where they were before has increased tremendously, especially since the pandemic. A sheet of plywood before the pandemic used to be $20, then it went up to $100, but now it's back down to $60 or $70. So the actual cost of the claims has increased tremendously. So with every fire or every water damage claim, the cost to repair those is going to increase. So underwriters have to make sure that there is sufficient premium on the books to pay for those claims. Otherwise, their loss ratio is going to be outrageous. So even though there may be some sort of tempering of the rate, there has to be a situation where the reserves are going to be able to sustain the premium that they're taking. So the market may fluctuate tiny, a small amount, or it may plateau or go down a few percent. But as long as the claims are going to happen, there's always going to be that need for premium to make sure that those claims are paid. So in my point of view, I think, as Jim says, it'll be more of the same. But I think with the cost of repairing these structures, I don't think the dips are going to be as large as they have been in the past.
Last but not least, Ollie.
Yeah, I mean, from my perspective, I think, 2026 is going to be an interesting marketplace. As I mentioned earlier, I think we're coming off the back of a certain amount of uncertainty from natural catastrophes that have happened. But equally, I mentioned that I do expect to see more capacity coming in the market because of, the healthy pricing that's been out there for the last 2 or 3 years and the results that have been returned. What I don't see changing is that discipline. There will be new startups that come into the market. There'll be capacity coming from other areas that we haven't seen before. But I think ultimately, whatever capacity is out there, some of it will be soaked up by the increased values that we're going to have to see through the inflation. And I think there has been a discipline that's returned to the insurance sector, and I don't think we're quite ready as an industry to say all's good now. We've had one good year. The wind didn't blow in America, so we can take price down. So I think there'll be increased competition for certain business, and you'll see price come off on some of it, but on the whole, I think there'll be a consistency to the insurance pricing that's out there for the next 12 months. It'll be interesting to see what happens through to 2026. But yeah, as I mentioned before, a softening hard market.
Well, this is recorded, so we'll see if these predictions hold true. We'll see what happens in 2026. But Ollie, Tony, and Jim, thank you so much for joining us today. We could continue this conversation much longer, but it's time to wrap things up. Thank you for tuning in to Flip the Cap, the industry's premier podcast that delivers insurance insights with a twist. We'll see you next time. Cheers.